So one more income strategy that you can see, which is current income strategy. What do you mean current income strategy? See, this means the strategies and all. If you are looking for career into investment advising or portfolio management, or let's say maybe with the traditional or alternative investment portfolios, then all the income strategies or strategies for investment advising and all, so that will be very helpful to you guys, correct? If I take the example of your current income strategy, current income, it means, for example, let's say you have 100 rupees. So you can transfer 30 rupees to the stocks, 60 rupees to the bonds or maybe government securities, and then 10% into money market, or maybe you can carry as a liquid cash. So this is how you can allocate the funds to the different financial instruments and design the income strategy. Why income strategy? Because 60% fund, if you allocate to the bonds offers fixed income, maybe on a monthly or quarterly basis. And that's what we call it as a fixed current income strategy, right? So let's see next. Another one strategy, income and growth strategy, right? Income and growth. Why we'll call it as a growth? If you see, while moderate risk assumed from the fluctuating interest rates, this strategy provides the greatest level of income. And even at an individual level, if you want to design your portfolio, income and growth portfolio, so you can look for three options. One, which is a stocks, where you can invest. For example, let's say you have 100 rupees. Again, how you can allocate? 40 rupees you can invest in stocks. 50 means little bit percentage in a stock investment that we have increased. If you go and check the previous strategy, we had invest only 30 rupees, but here with this particular income and growth strategy, this one, we are going to invest around 40 rupees in different stocks. And even that stocks investment also you can categorize into different stocks as well. For example, let's say uh, small cap, mid cap, large cap, or penny stocks, or maybe even sector wise also you can design the stocks portfolio as well. Let's say infra, EV, electric vehicles, all right, chemical, IT. There are a number of things in an in a that particular sector as well. So accordingly, you can target the niche segment, or maybe key key growth factors from different sectors, and then you can accordingly design your portfolio. And 40% 50% investment that you can invest or infuse fund in the bonds investment. Bonds, it means it is a kind of a balance. So 50% on a 50% investment, you will continuously receive the interest payment on investment, and 40% investments, here you might see fluctuations, maybe ups and downs, depends on the market trend, right? And 10% you can carry as a liquid cash, or maybe you can say you can invest in, let's say, money market instruments like loans, repos, CFDs, or short-term instrument, very short-term. So quickly you can convert into cash at any point in time if you need it. So that's how you can design your income and growth strategy. All right. So another strategy, if you see, you need a long-term growth strategy. If you want to design the long-term growth strategy, so here if you see how things would be different under the long-term growth strategy. If I take the example of income and growth, if we compare these two together, here we have invested 40% in stocks. But under the long-term income growth strategy, will invest 70% in stocks. And that's how your allocation also, it will change automatically. Say this, 70% in stocks, 25% in bonds, and 5% cash only in, means, money market instruments. So that becomes your long-term growth strategy. Long-term growth strategy. So now if you want to design your portfolio, so you can target, three segments. One is money market segment, another one is bond, and then stock market. All right, 70% fund you can invest in stock market, 25% fund you can invest in bond market, and 5% fund invest in cash market. So if you have this strategy, then you can call that strategy as a long-term growth strategy. Why growth? Because stock market provides significant growth and bond market provides moderate growth. Because bond market offers interest payment, right? 7 to 8% interest payment on an annual basis. But stock markets, that depends. Even if you see 2 to 3 stocks, if they perform well in your stock in your portfolio, still you can generate 20 to 25% returns on an yearly basis. All right. So another strategy, if you see, aggressive growth strategy. Aggressive growth. When we say aggressive, it means, see, when you invest 100% fund in your stocks market, then we call it as very aggressive, right? But if you invest 80%, let's say you have 100 rupees, always take the same example so that you can understand. 100 rupees if you invest, let's say out of 100, if you invest 80 rupees in stock markets or different stocks, that, and then 10 rupees that if you can invest in bond market, and again 10 in cash market. So eventually 80% fund that you want to invest in stocks, and 10% funds that you want to invest in bonds and cash. So this strategy become your aggressive strategy. All right, this strategy become aggressive strategy for a stock market or for a particular that investment. Allocation strategy, you can call it as an aggressive growth strategy. Definitely there would be growth, but that doesn't mean only you will see growth. You might see down growth as well, upward growth and downward growth, right? Because see, stock market prices are sensitive. Sometime you would see prices are up like this, right? Let's say you invested at 400 and now the market price of that investment is 600. So it means here you can see growth, right? 50% growth. What if after 50% growth there is a downfall and the current market price is, let's say, 200? See this, 50% down growth. Because we cannot predict, right? The market prices, which are sensitive, volatile at any point in time, if you can see the movement in stock prices, so we don't have any control on it. But in case of bonds, at least you can say the price of the bond, means face value of the investment, would be fixed. Of course you would say risk, but again, so the face value and the interest payment would be remain same, so that they will receive on time to time. But yes, if you invest major of the stake in the stock market, so that theme you can call it as a aggressive investment strategy. So all are the strategies which you may expect question maybe in your CFA, CA, CPA, or FRM exam. And apart from that, if you are looking for, as I said, if you are looking for investment banker roles, financial analyst, or maybe if you're looking for any advisory roles, you should know each and everything around this all investment strategies. And if you don't know, so you might see challenges as well then in terms of to getting on board with the top-notch companies. All right. So I'll take you ahead and to see what we have other things to discuss. around the same, the concept of risk, beta and return, right? Calculation parts I will separately design in a separate session on it with examples, because theoretical thing, if we only discuss theoretical things, that won't help much. But I'll just discuss the concept. I don't have a prepared example for it. I'll just discuss few things, means theoretical things, so that you can relate at least. When we say risk, right? When we say risk, understand this. What is the difference between risk and return? If I take the example of, let's say, stock market, let's say Wipro beta. Beta means which is the risk, right? Current market price is, let's assume it, 300. If the beta says, if I calculate the beta, if the beta says stock market price of this, Wipro is beta, means I'm talking about beta. If the beta is negative, if the beta is negative of 100 point, let's assume it. So this price may go up to 100 upward. The beta is positive. So it means if the risk is positive, then you might see downward risk of 100 rupees. So this is how your beta works. So now let's say if the beta is positive or negative of this particular stocks, then you can invest, right? You can invest. And if the beta is negative, if the beta is negative, it means you can invest. And if the beta is positive, so you might see that stock price will continuously or will fall in near future. And that happened. So that is how you can link beta with the risk and return. Beta help to understand the situation of investment or volatility of that particular investment, or risk of that particular investment, and on the basis of that you can take the investment decisions. If the beta, as I said, if the beta is negative, means after calculation, if you see if the beta is negative, so it means you can invest in that particular stock or you can hold the investment. And if the beta is positive, so it means here you might see downward risk. So you can maybe look for a hedging or take the exit from the portfolio investment. So this is how we calculate the beta, and you can relate that beta with the risk and returns. Now I'll come to the returns or risk part. So when we say risk can be defined as a possible variation in cash flows about an expected cash flow, right? So if I take the example of, let's say, stocks, all right, we cannot predict stock prices, right? Cannot predict, it means surely you cannot, or nobody can give a guarantee of that prices. Correct. It can be up, it can be go down, it can be stay at a same level. So nobody can provide any guarantee, nobody can provide any assurance the prices of the stocks will be remain same and all. No, nobody can provide it. So that depends. And that's what it's important to understand it. So if you want to calculate the risk, for example, let's say you have invested at 300 rupees price. For you, the important is, let's say you invested 1 year back. All right, 1 year back you invested. So now what if the prices of that particular stocks are 250? So here if I ask you the risk, so you would say the risk would be 50 rupees. Why? Because current market price of the stock is 250. And if you sell that stock at 250, so you will receive again 250 rupees. So it means you have lost 50 rupees value of investment, and that 50 rupees becomes the risk for you. Why? Because of possible variations, right? What if instead 250, current market price is 450? So in this case, you would see 150 rupees possible variation, or I would say positive variation in the particular stock price. And the same that the beta help you to calculate the variations. what would be what would be the case where, let's say, positive variations or negative variations. So that beta will help you to calculate the variations, and then accordingly you can calculate the uh, possible beta, or I would say risk of that particular instruments on time to time, and then you can take the investment decisions. So I hope now you got the idea about why the beta is important, because beta provides you the volatility of that particular investment. So at this point in time, just keep one thing in mind. If the beta is, let's say, positive, so it means it's a downward risk, price downward. And if the beta is negative, it means it's an upward movement. Investment will go upward, sorry. And if the beta is neutral, it means you don't need to invest, or even you don't need to sell anything, just hold. Means if you have investment, hold it, right? Or else don't do any activity at the moment, because there is no movement as per the beta. So how you can calculate the beta, and also we'll take the example not now, but as I said, I'll develop separate sessions with the multiple examples so that you can understand it. If not, you can nowadays means you can check it on Google as well. Okay. So different types of risk, market risk. So an assets may lose market value because of economic and other swings in the overall market or conditions affecting the assets itself. If I take the example of, let's say, stocks, you can relate with there are many more other instruments as well, but I'm just giving you one example where the stocks can be your market risk, reason, where due to the, price variations or economic growth, political instability, and there are a number of other factors that can create the risk in the investment, and that risk we'll call it as a market risk. And what about the credit risk? Your bonds investment. When you invest in bonds, and what if at the time of maturity that the lender, sorry, borrower, it means the company who issued bonds to you, that companies fail to repay the debt or fail to repay your payment. So that investment become that investment, you can call it as, okay, so credit risk investment. Why? Because you offer credit, and now that company is not able to repay your amount. Vice versa, if I take the example of, let's say, if I take the example of, you have taken a loan and now you're not able to repay that loan due to XYZ reason, or maybe let's say you lost your job and now you're not able to pay the personal loan, right? So that loan become the credit risk, correct? And what if I take the example of inflation risk, the currency in which an asset is based may lose purchasing power. Inflation, it means this point or this particular inflation was in news, and still it's which is in news across globe. Why? Because the inflation rate is very high in uh, US market, right? US and UK market, especially in US market. If you see their bond market yield, which is at 5 to 7%, and inflation, which is at again 5 to 7%. So this become no yield from the bond market investment. And what if inflation overtake the bond market yield? If the inflation overtake the bond market yield, that becomes negative yield for a bond market investment. So it means even in this condition also, that doesn't make any sense to invest in bond market, because there are no opportunities to generate the alpha or generate the income from this particular market. And that's what inflation risk is also important. If the inflation is high, then most of the investors, they don't invest in that particular even country economy and even that particular sector as well. The reason is due to yield, that will affect on the yield. For example, let's say if I take the example in another way, let's say there are two countries. One is India and another one is US. Let's say India, if you invest in India, so they have a 7% inflation, and US has again 7% inflation. If you invest in India, you can make 15% return, and if you invest in US, you can make only 7% return. Now you tell me which market you will prefer. I'm sure you will prefer the Indian market. Why? Because that beat the inflation. Inflation, it means cost, guys, right? Cost of investment, or cost of your lifestyle, or cost of other things that you can say. Correct. So definitely you would prefer the Indian market, not the US market. Why? Because the alpha and the income is high for Indian market. So that's how you can categorize the different risk and relate with it. And you might expect questions if you are, let's say, CS, EFA, and if you're looking for entry level jobs, still you may expect questions around it. So you should know it: beta risk, return, market risk, credit risk, inflation risk. What is the risk? So you can prepare examples as well so that you can explain it in a systematic way. Calculation part I'm not going to discuss here. So I'll will have a separate session on it, but theoretical aspect I'll discuss and decode it. All right. So apart from that, so you might see the liquidity risk as well. Like when we say liquidity risk, so you may see the situation where you are not able to sell that particular assets, or it is difficult to sell that particular assets. Sometime that happened. Let's say you invested in XYZ stock, and let's say that stock was a penny stock, right? At the time of, let's say, buy means when you're investing, there was enough liquidity in that particular stock, but now let's say there is no liquidity. The reason is that company has let's say found some scandals, and that's what you're not able to sell that particular stocks in the market. So that becomes your liquidity risk. So understand that aspect as well, right? Find a investment, or find a stock, find bonds which are highly liquid, and if which are highly liquid, so it means you can easily buy and sell. If I take the example of stock market, NSE and BSE based companies, those are highly liquid, so you can buy and sell within a 1 day as well. So it means there are no difficulties as such while buying and selling the securities. If I take the example of money market instruments, let's say call loan or repos and all, so you can see overnight repos as well. Or if I take the example of different financial government instruments, so you don't need to worry about liquidity. You can sell that in the money market as well, means to anyone, right? So look for a highly liquid investment. If you look for a illiquid investment, for example, preference stocks, right, or unlisted stocks, even loan. So those are not a liquid one. So it's difficult to sell loans to someone else. So it's a illiquid, and that's what you would see risk as well. If there is no enough liquidity in the market, then that doesn't make sense to invest in that particular securities. All right. Then interest rate risk. The market value of fixed income investment moves opposite to the market interest rates. All right. Investment moves opposite to the market interest rates. Why interest rate risk is important? To always keep one thing in mind. Always keep one thing in mind. So interest rate risk, it means if the interest rate of that particular country is increases, so that lead to the interest rate risk. How it works, I'll quickly explain it. For example, let's say you have invested you have invested in XYZ company, let's say ABC Limited, at 7%, and which is a fixed. What if government change the interest rates or announce, let's say RBI announce the interest, and now the current market interest rate is 11%. Right? When you had invested, the interest rate was 7%, and now, as per the current market, the interest rate is 11%. Here you are losing almost 4% interest payment. Correct? So that's the interest rate risk. So which you can protect, or maybe you can sell this investment and buy a new investment with a higher rate of interest. So that's how you can see the interest rate is risk as well, and vice versa. Sometime might be you're getting 7% interest rate, but maybe in the market, let's say there is 4% interest rate, right? So that also happens. That comes under interest rate risk. All right. So other risk that you would see, reinvestment risk. When reinvesting a bond's principal and interest proceeds, you might not get as high rate because market interest rates have declined. So at the time of reinvesting, you should evaluate the market, and if the market interest rate is good, means in your favor, then definitely that would be a positive move. But what if at the time of reinvestment the interest rates, or let's say market is not in a good situation to invest? There could be a number of things that we should evaluate. All right. And same you can apply here as well. So investment risk, it means when reinvesting a bond's principal and interest proceeds, you might not get as high rate because market interest rates have declined. So at the time of reinvestment, you can evaluate the beta, you can evaluate the certain risk factors, and then accordingly you can take the investment decisions. And that comes under your reinvestment risk. And finally, currency risk. An asset denominated in a foreign currency may lose value when the home base strengthens. So what it means, because always see, now we have a base currency which is USD, and our home currency is INR, right? So due to the currency fluctuations, now if you see, $1 is 82, but before pandemic, or maybe in the 2014, 16, 17, if you see, $1 was 52. So 82 minus 52, if you see, around 30 rupees. So we have lost, or rupees lost the value against the dollar. So even if you make, let's say, handsome return from the Indian market, and if you convert or compare that with the dollar, so you might see, the negative impact on your investment because rupees depreciated already. Now at the moment will have to pay 30 rupees extra. For example, let's say if you want to understand this currency example, so you can understand in a different way. And let's say you've taken $100 loans in 2015. At that time, the dollar value was 50 rupees per dollar. So it means when you took a $50 loans, $100 loans, the Indian INR price was 52 rupees. So you paid 52. Means you convert that and you utilize it, that becomes 5,200. Right? So now at the time of repayment, let's say you are now looking for a repayment in 2023. So if you want to repay that, so same $100 into 82, so that becomes 8,200. So you will have to pay 8,200. So it means you will have to pay around 3,000 from your pocket extra. So what it means, so rupees value has been depreciated. What if vice versa? Take the example. Let's say you take a loan at 52 and the current market price of a dollar is, let's say in 2023, so dollar price is in INR, which is let's say 42. If this is the case, then definitely you would see some positive, benefit from this currency conversion. How? So now here you can convert 42 into $100. So that becomes 4,200. So it means 5,200 minus 4,200, 1,000 rupees positive gain from the currency conversion. And this is what you can call it as a currency risk. So when you see risk, so you will definitely, have some risk measurement parameters as well, as I said. So there are a number of things to calculate the risk, but few, parameters which really helps you to calculate or to measure the risk so that you can, hedge your portfolio or try to mitigate or control the risk of your investment portfolio. Market risk refers to the fluctuations. Here, we'll discuss the theoretical aspect. Market risk refers to the fluctuations of an investment price, volatility, or potential loss in market value at the time you need to liquidate. Wall Street has found a way to actually measure the risk of certain investments in terms of price volatility. All right. Alpha means with this measure, you can give how much better an investment or portfolio performs given its risk. Alpha is the return over and above the market average as measured by the S&P 500 index. So alpha is measured by the S&P 500. S&P means Standard and Poor 500 companies index, and alpha of 0 means you are being adequately compensated for a risk taken, and higher number reflects better than expected performance. If the alpha is 0, so it means you are being adequately compensated for a taken, and if the alpha is more than it means you can expect the returns of that particular investment is better than the expected one. And if I take the beta, with this measure, you can give a security price volatility. As I said, you can measure the volatility. Beta means volatility relative to the overall market. Theoretically, a portfolio or security with a beta of 1 moves in line with S&P 500 index. A beta higher than 1 denotes greater price volatility than the overall market. If the beta is higher, then market price volatility is also higher. And statistically, risk may be measured by the standard deviation of the random cash flow. Standard deviation is denoted by alpha and is calculated as follow. Alpha summation n summation interest rate is equal to 1, interest rate for a particular duration, extended rate, and then 2 principal. So this is how you can calculate, but I'll have a differentiation on calculations part as well separately to cover up this portion also so that you can understand. Now I hope you got the idea about the risk and different types of risk and how you can measure and all right. Then where is the number of states of the economy which is, let's say, return and in principle is the possibility of the state of economy. The risk variability of the returns can be divided into the variability of returns and unique to the security, commonly referred to as the firm specific risk or unique risk or diversifiable risk or unsystematic risk. The risk related to market movement, also referred to as a market risk or non-diversifiable risk or systematic risk. Market risk, it means sometimes we cannot see, we cannot control the market risk, right? A risk is a risk. Sometime we would be able to control, sometime we won't be able to control it. For example, let's say political factor that is not in our hand, social unrest or maybe movement or any kind of regulation come into picture. So those are the risks which we cannot control it. But sometime, let's say before investing, we can take a good decisions and try to avoid that or control that risk. Once you invest, and if something happened, then we cannot do anything. And that's the risk. All right. Then measuring systematic risk calculation part, I'll take it later on because I don't have even prepared the examples for it, but I'll take it separately. But measuring systematic risk affect all securities. To measure systematic risk, we measure the tendency of a stock to move relative to the market. The plot of firm excess return versus market excess return is called the characteristics line. And then risk calculation system, required rate of return expressed as required rate of return plus the rate of future present, where the R is the investor's required rate of return and RF is the risk-free return, risk-free plus required rate of return, and RP is the premium. Okay. All right. So that calculation part we'll discuss it later on, or I'll design separate video because with the theoretical aspect, I don't like to discuss things. We should have a proper examples, real examples which you can relate. So that's how I'll cover that portion. Okay. So now here if you see, yeah, this portion we are going to cover about your uh, about the balance sheets, income statement, and about the P&L or different things, and see how you can relate that in your investment banking or uh, fund accounting, fund admin, even financial analyst roles, analysis roles, because balance sheets, P&L, income statements, fund flow statements, and the statement of operations and all, those are very crucial. So entire finance teams or banking teams, even they work on the similar sort of statements. All right. So here let's start with the balance sheet then. So balance sheet, it means, if I take the example, if I ask you what is balance sheet according to you, definitely that you would say it's a mirror of the business. Why mirror of the business? Because that defines the current situation of your business, your payables, receivables, current assets, fixed assets, long-term assets, right? And all other information balance sheets will provide to you, and on the basis of that you can take the investment decisions as well. All right. So now if I take the example of, let's say, your fund, your particular let's say investment or company raised 1 lakh crore or 1 lakh from the XYZ investors, and now they invested into XYZ activities, and even they have a 20,000 cash in their account also. So now if I ask you to calculate the current situation of your business for that particular investment, right? How will you measure, or how will you evaluate if there is no balance sheet in place, right? So it means without balance sheet, it would be difficult to calculate and relate that, or to analysis the data and all. But if you have a balance sheet in place, so that provide you each and every information, and on the basis of that, you can take the investment decisions. All right. So balance sheet represent a statement of the financial position of the firm on a given date, and its assets, holding, liabilities, and owner supplied equity. This statement is considered the most important financial statement for judging the economic well-being of the firm. And the balance sheets consist of two basic components. One is assets and another one is liability. Or third portion you can say, which is owner's equity. Owner's equity, it means capital. And liability, it means it's a payable portion. And assets, it means firm's resources, firm's own resources, which they can utilize to generate the revenue. So that's how the balance sheet provide the exact picture of your business. Now let's discuss the asset component. What it is mean assets. On the asset side of the balance sheets, we usually find two categories. One is current assets. So it means all receivable so that you can treat as a current assets, or cash also that you can treat as a current assets. And apart from that, if you see any short term, you know, receivable, if you see dividend receivable, interest receivable, then rent paid in advance or expenses paid in advance, if you see any hits or any items as such, so that becomes the current assets of the business or current assets of the fund, even for that matter. And then fixed or non-current, it means long-term investment. If I take the example of fund, so equity investment, bond investment, equity investment, bond investment, or maybe loan investment. So that becomes the long-term investment, right, or non-current assets. But if I take the example of, let's say, derivatives or any option trades, short-term option trades and also that you can say it's a current, right? So current assets, fixed assets, so that changed on the day, when the that segment change or business change. If I take the example of that's a normal business. So here if you see plant or equipment land, that becomes the fixed assets, right? And if I take the example of fund, then equity bonds, loans, that becomes the fixed assets, right? So that's how you can relate, and all are comes under the assets. And one more tips that I would like to share it here. All assets, you can record it to the debit side. Debit side. And all assets affect on the debit side of P&L also. You can check my other videos on basics of accounting. All right. So what next? About liabilities. So here you would see two types, again in 2 to 3 types in liabilities. Liabilities, it means represent the outstanding claims held against a firm's assets and are categorized of liabilities. It can be taxes, it can be loans, it can be any payables, right? Short-term payables. So that becomes your liabilities. Current liabilities, it means they represent obligation that are reasonably expected to be liquidated within 1 year. For example, let's say taxes or any rent payable or fees, management fees payable, admin fees payable, anything as such, if you see, that becomes your current liabilities. And what about the long-term liabilities then? Long-term liabilities includes permanent obligation of the firm that are not reasonably expected to be liquidated within the a year or maybe within a short term span, so that you can see loans or maybe even for that matter bonds. If the let's say XYZ company raised funding through bonds or maybe loans, so that becomes a long term liability. And then what about the owner's equity then? Because owner's liquidity also be recorded to the credit side, correct? Owner's equity represent the book value of owner's interest in the asset of the firm. Owner's equity represent the ownership in the that particular company, and the assets, I would say, whatever assets which you have recorded in the books of company or fund. So that equity represent the same ownership in the assets as well. And owner's equity is comprised of a capital stock par value of a common stock plus paid in capital and retain earning, undistributed earnings as well. So means income and all that you can record it under owner's equity. All right. Any questions? If you have around it, you can text you can post me in the comment section, so I'll reply to you. Then the income statement, so also known as, you can say, income statement, also known as, you can say, P&L, profit and loss account statement, right? Profit and loss account statement. So it means here you can record the profit and loss as well as income and expenses of a firm. Simple. So income statement represent an attempt to measure the net result of a firm's operations for a specified time interval. Some of the more important components of the income statements are discussed below. Sales represent the total sales of products or services, net of returns and allowances attributable to the period. Cost of goods sold is simply the cost of the product and sold or service provided. There are two widely used methods for computing cost of goods sold. The first in, first out method assigned to cost of goods sold, and the prices that the firms paid on the oldest item in the inventory. And the last in, first out method assign cost to items sold based on the cost of the method recently purchased inventory items. And the method selected can have an important effect on a net earnings for a period in which prices have risen or fallen significantly. And the other items means you can record the goods on the basis of LIFO and FIFO. Simple. In a fund accounting, you would have seen. So when we book the trades in the XYZ system, we also apply the method. Method, it means allocation method, LIFO, FIFO, pro rata. So it's a general method or general approach to record the goods in the books of account. Gross profit represent the amount by which sales exceeds cost of the goods sold. And then selling expenses, general and administration expenses, or a number of things. So here on P&L you can record, as I said, two things: profit and loss or expenses and income. If you see any expenses such, so that you will have to record it. If you see any profit as such, you will have to record to it. Net operating income, net income after taxes, retained earning. So everything that you need to record it. Insurance, salaries, advertising expenses, promotion, and many more. So you will have to record it out. All right. Okay. So this portion, the NPV, time value and also will have another session, as I said. So we'll cover in that. All right. Expected rate of return. Maybe let's complete this one as well. So time value of money. So this one is a very interesting aspect, guys. Time value of money. It means, for example, let's say, if I take the example of, let's say, rupees, where you invested rupees 1 year, right? If you let's say, if you invest 1 rupees here, right, you will receive 1.110 here. What it means, when you invest 1 rupee here, after 1 year you will receive 1.110 rupees, or 1 rupees 10 paisa, right? So what if I say, when you invest here, When you invest here, let's say 100 rupees, and you receive here 1110, right? Means 10% return. But out of 10% return, the inflation of that particular, let's say, country is also 5%. So now you tell me, if I ask you after 1 year, here if I ask you question like how much return that you have earned throughout this year, I'm sure your answer would be, let's say, you can apply the 5% on this total investment, 1110 into 5% divided by 100. Just calculate it. 1110 into 5 divided by 1110 into 5 divided by 100. 5.5, 105.5. So this should be the actual value of investment. Why? Because of time has a value in finance, right? Because of time has a value in finance. Without time, or without time, or without considering cost, we won't be able to calculate the actual value of investment. And that's what time value is a very important factor, or that plays crucial role while calculating the prices of different securities. All right. You see here, when we calculate the net present value of any investment, or when we consider the future expected cash flows. When we say future expected cash flows, it means we are talking about bond coupon payment. All right, coupon payment. So always we'll have to minus the cost. Cost is, it means it's the inflation rate of that particular company. All right. NPV measures the value created by a financial decision. Positive NPV increase the wealth. If the net present value of investment is positive, then your wealth will increase, and a zero NPV decision earns the fair rate of return, and a positive NPV decisions earns more than the fair rate of return. Then what about required rate of returns? Required rate of returns, it means the return that exactly reflects the risk of the expected return of cash flows. Return that exactly reflects the risk of the expected future cash flow. A person requires the return from an investment before he or she is willing to make the investment decisions. So you said how much returns that you want and compare that with the investment segment. For example, let's say you're looking for a 25% return or 20% return from the stocks. First of all, see if that stock market is offering 20% return or not. If not, then that doesn't make sense to invest. So see your expected rate of return and compare with the market, and then accordingly you can take the investment decisions. All right. What about expected rate of return? It is the return that an investor expects to earn from the investment. As I said, so first of all, see how much is your investment returns, and then accordingly you can look for an investment opportunity. If it is equal to the required rate of return, the investment has a zero NPV. So it means your expectation and market returns, if those are in line, so it means zero NPV, net present value of investment. If the greater than the required rate of return, the investment has a positive NPV. That means if you're expecting, let's say, 5%, and the market returns are, let's say, around 10%. So that becomes a positive NPV. And vice versa. You are expecting 10%, market returns are 5%. So that becomes negative NPV, right? Then what about present value formula? Present value, then future value at a time of investment, and then rate of return or discount rate period. If it is less than the required rate of return, then the investment has a negative NPV. So theoretically, you can relate that present value formula. Future value formula, let present value, future value at a time and an interest rate, discount or profit. So we'll cover the entire formulas or examples in one dedicated session with the multiple examples, so that you can understand in a better way. So because throughout this means this is for a theoretical aspect session, and if I cover the all the formulas, at least we require 2 to 3 hours to discuss in details about each and everything in details, right? So we'll cover that in a separate session. So yeah, hereafter we'll start with the stock market and key terms. So please continue with the series. We are done with the 2 episodes. After this series, you can have an ample amount of expertise from the capital market or stock market, bond market, or different markets. So you can work as a financial analyst, investment banker, advisor, auditor, right? Because this pre-course will provide you in detail insight about each and every aspect. You can refer this course to others as well. Let them also understand it, learn it, and grow them in their career. And if you're looking for any process specific courses, or let's say if you want to actually grow in your career, so you can join my uh, let's say mentorship program, so that offer a customized learning, so you can connect with me directly and you can grow in your career the way speed which you are expecting and all. So if you're willing to learn, you can even join my other recorded courses as well, that provide you enough expertise to work in different processes like corporate action, fund accounting, trade processing, reconciliations, and many more. Okay, so we'll see you in our next session on stock market, how stock market works, what is stock markets, why stock market is important. So we'll discuss each and everything about it. So meanwhile, thank you. Please share this content, and even click on like button, so that help us to record more content for you. Thank you. We'll see you in next session. Bye. Check the description if you're looking for any material and courses, because I'll provide you the link for a material so you can download it. Thank you.